Welcome to the Aramir Roundtable. Today is the 26th of May, 2021. We have a special guest, Iggy from Stuttgart with his Schwalbe Trade. Iggy's been with us for a while. Schwalbe Trade's kind of gone through a metamorphosis. Started out as the triple tool trade, and then he's changed the name and changed the way that the trade handles, and it just keeps getting better and better. So welcome, Iggy. We're looking forward to hearing more about the Schwalbe and how you've updated it and how the performance is.
Yeah, hello, Tom. Thank you for the invitation.
Yeah.
And I will talk today about my third version of my Schwalbe, which I trade since November 2020.
And for those people that don't know, a Schwalbe is the German word for a swallow, like the bird that you're seeing.
Okay, yeah.
Yeah.
And I changed my system because there were some events which I didn't like. And the main reason for this version is now risk reduction and harvesting not only every quarter, but 2 times a month. That's why you see here 6 Schwalben here and not one like in the first presentation. And my old Schwalbe added risk when the risk was already high, and the new makes only permanent risk reduction. So that's the biggest change in my version now, which I trade since November 2020. What I show here is proved by reality. I trade the Schwalbe live since September 2019, and so I was also live February 2020, and I survived pretty well. So that was the hard test. For me, risk reduction means also when to trade and when not to trade, and also what to do if you might get in trouble. Are you prepared for this situation? What if is my guideline for my Schwalbe. There can happen a lot of things, and you should be prepared before it happens. And during trading, I not only get feedback of my members, much more I get feedback of my live account, and it shows me exactly what to do. So, but first, I want to visualize what my way of trading looks like a little bit. So I think I can compare it a little bit by a motor race. My trading style is, for me, it's a little bit like a motor race. And most important is to arrive at the finish. Why? Because then you can start the next race. And look at the course and the racetrack. Choose a car that fits to it and pursue a certain tactics that fit. It is fine to be at the top for some seconds, but much more important is to cross the finish line. Then the chances are good to start the next trade. So here are 4 different racetracks or underlyings. The first one is, the picture one is a broad street, up and down, but still straight ahead most of the time. So it looks like a little bit like SPX. The next one here on the right side is more like stock trading based on a sandy subsoil. The third picture here is something like Forex here, big moves to the upside and to the downside and to the upside again. And the last one is like crypto trading, somewhere out in the wood, somewhere out of nowhere, far away from a street. So you have to decide what style of trading you want, and are you driving in, at, or out of the pack? When you are in the pack, you can decide which position you like. You can drive in the pack, that's a lot of stress. You can drive here, that's a little less stress, but you can also drive here out of the pack, still have time to say hello to someone or doing something else. Or you drive very, very slow, and Paris-Dakar will probably be finished in a year. So trading style, choose your trading style. Do you like here volatility trading or gap trading, or do you prefer all in? Oh, it looks more like here all out at the moment, or are you still demo trading? And of course, there are situations when you should not, when you really should not trade. And as I said at the beginning, what if? And if I can't see anything, don't start a race. And if the subsoil looks like this, it's better to not start. And sometimes it's better to stop the trading when there's a bigger damage, and also stop if subsoil changes and you don't know how deep the water will be. So, and also choose your vehicle, choose your setup. The yellow car is too big, too dirty, too heavy, too slow. The red one looks comfortable, but really suitable for a race. I prefer for racing a reduction to the essentials: a seat, a steering wheel, a fire extinguisher, and roll bars. No air condition, no radio, no hi-fi surrounding sound, no sunroof, no interior fittings at all. And most important, arrive at the finish line. Arriving at the finish line is most important. Better some places behind the top with much less risk and stress, then you can start the next race. Okay, now let's talk about trading. The racetrack, the underlying. This is the SPX trending since 1950. And I often hear we are in an uptrend at the moment. I answer, yes, we are in an uptrend since 1950. If you look at the bigger picture and therefore adapt the trading style, then you are still in a good uptrend. And my Schwalbe needs a trend in the underlying. It doesn't work for Forex, for example. And the next theme was in, at, or out of the money. I prefer trading out of the money. I put my put strikes below close end of day with the 3 months trade duration. And here you see, for example, the example for one trade, but I trade 6 trades at the same time, but of course with different entries and exits. And most important for me is give the trend time to develop. 1 week and 1 month is too less. As you can see it here, when you have here only one month, you will have a loss. And also 1 week, you might have a loss very often. And if you give the trend time to develop, then 3 months is a pretty good trade duration. 1 year is of course too long and not as profitable as a quarter. Or if you look, if you want another picture, you need a bridge which is long enough to reach the opposite bank, or you can place some bridge pier. And what I really recommend is stay out of the battle zone at the money. You have here at the money many movements up and down, and you get much more risk when you are trading at the money. Go out with some bigger profits, but with much more convenience. You will be surprised how pleasant, easygoing this Schwalbe trade is. Not much to adjust and being prepared for bigger drawdowns. And bigger means drawdowns of more than 10, 15% up to 20 or 30, like in February 2020. My trading style. I trade like an insurance company. I sell an insurance and I buy a reinsurance and hope to keep the limited premium, of course. I keep out of the danger zone at the money and I take max winners instead of max risk. And of course, I have rule when to exit or when the risk is too high and when not to enter a trade. And of course, I do a permanent risk reduction, which was the main theme for my new version of my Schwalbe trade. And max risk is max profit, is max stress, and means sitting in front of the desktop all the day. That's active trading. I prefer, like an insurance, passive trading. An insurance company sells insurances. I sell put options, defined strikes, and defined expiration. I get pretty the same premium most of the time, no matter where the exit is, as long as it is above my sold insurance. And very important, time is on my side when the SPX is above my sold put. And to have an advantage right from the beginning, I sell a put some distance below the current price. And here you see in my system when to trade and when not to trade and what are the knockout levels. You see all the blue lines here are the knockout levels of each individual trade. And the red line means don't enter a new trade. But of course, the trade is already entered. And here I don't enter new trades. This was the dot-com bubble. And here was Lehman. And I show later on in my software how much this happens. And here you see something more in detail. You see here at the top my 6 trading systems, which gives the signal. It starts on the 3rd Friday in January, February, and March, and 14 days later in January, February, and March. And here you have the SPY here in this example, but it doesn't matter if it's SPY or A-mini or SPX, it's pretty the same. And here you have the blue lines are the knockout levels for each trade. But I don't enter at the money, for example, I enter some distance below. And the blue line means when the SPX is crossing the blue line end of day, I am only trading end of day. I reduce the noise of the day and I only trade end of day. And when the blue line is crossed for each individual trade, I stop trading. But stop trading not necessarily means that it will be a loss, because I make risk reduction all the time, which I show later on. And here again, you see on the top 6 trading systems running at the same time. And the blue lines are the individual knockout levels for each trade. And here you have the examples here for a trade always starting here on the 3rd Friday, on Monday after the 3rd Friday, which is here in this example, October, and then January, and then April, and so on. And crossing knockout levels really means stop trading, but that really must not be a loss, because expiration line might already be above 0. And additional to that, there are 3 adjustment levels. The first one is here one. The second one is here the black line. And the third one is here my Schwalbe signal. And when I get this signal, I have to be prepared for a move to the downside or a move to the upside again. I have also I have to be prepared for both scenarios, going down or going up. Because when I prepare for a move to the downside and I prepare for until to the maximum, but it will return to the upside, then it means I have to add insurances for the move to the downside, and I have to pay for them. And if I have to pay for them, then of course I reduce my premium, which I got at the beginning. So, and the adjustments here of each trade, of course, depend on volatility of day till expiration, which risk reduction already installed, etc., etc. And adjustments need, of course, experience. Which of the 6 trades are the most vulnerable trades? Because I am trading 6 trades at the same time, and where to adjust for what price with which result. So this means you need a little bit experience, and in my trading room, in my Schwalbe room, I show exactly what to do if there will happen something like that. And of course, for trading, I choose my setup and I reduce it to the max. And the most important thing is then it's also simple to manage. And I do it like an insurance company. It's a proven business concept. And I sell an insurance and I buy a reinsurance. And that's the biggest change to the old version of the Schwalbe. Because on the old version of the Schwalbe, I had here a butterfly, and I sold a wing of the butterfly when the risk was already high. With a new version, I don't add risk to the trade. I do it in the opposite way. I will always reduce the risk step by step. But of course, I will reduce here a little bit my profit, but I think that's worth it because reducing the risk is okay. Why? Because when you have to be prepared for a move to the downside before it happens. When you are on the move to the downside, and then you want to start protection, it will be much more expensive than when you do it when there's no need, in parentheses, when there's no need for a correction, for a risk reduction. And of course, I take the risk, but only to a certain level, and then I protect myself. And the more simplified the model, the easier to manage, of course. Better than, for example, if you have a butterfly, a calendar, and a jade lizard, and then you get in a high volatility situation, then have fun with some adjustments. And here my trade management, and that's the main thing here in my Schwalbe trade. Schwalbe trade is based on levels, not on indicators. I think that's a huge, that's completely different of my normal trading, which I made which I did some years ago. And my Schwalbe is now based on levels and not indicators. I don't care about technical analysis. I don't care about calendars, straddles, strangle, and so on. It's really very, very simple setup. And it's really KISS. Also keep it simple, stupid. I only use verticals and a back ratio. I have no broken wing butterfly, no fat tail risk, no whatever. And I use very often good till cancel orders to minimize risk step by step up to above zero for the expiration line to move it to above zero. And very important, old trades protect younger trades, because when I moved a trade to the upside above zero, then the old trades can protect quasi the younger trades. It's like a phalanx. You have 6 trades at trading simultaneously, and therefore I spread my risk and I trade 6 trades simultaneous, which protect each other. And of course, I have fixed levels for adjustments in a drawdown. And 6 levels mean 6 different knockout levels, different risk reduction, etc. And really, it's like a phalanx, a 6-pack permanently renewed by new trades and risk reductions. And here you see what a protected trade looks like. And this is a trade about 2 to 4 weeks before expiration normally. Here you see the different protection levels. And at the beginning, there was here in this area there was the sold vertical, and I reduced the vertical, but this is the last step. The first step is adding simple verticals to the trade, which moves up here the expiration line step by step. And here's also a back ratio, and the back ratio can of course move here the T+0 line massive to the top, but it's really hard to manage because a back ratio in a massive drawdown, it's riding a wild horse. And I call here this risk reduction here by the verticals, I call this a stairway to heaven, and mostly implemented in vain, but you will never know. And I try to buy them all for a really cheap price. And I want to stay out of trouble. I spend some of my profits for much less stress, and I get much more comfort. And I still get nice profits, as you can see in my performance list. So this trade here is fully protected, and I can't make any more profit as long as it stays here on this level, except when it's really, there's a huge move to the downside. And then I always also get some questions. why don't I take early profit? And the example for this is, here I have my 6-pack. I have the 6 trades running at the same time, and the trades here have the protection. And this protection leads to a protection of the whole 6-pack. If, for example, I take profit early, then I have only 4 trades running, but look what will happen. And this is the risk navigator of interactive brokers. And this means here, when I have here a move to the downside, I really don't get in trouble. When here I have a move to the downside, then of course here my profit is running a little bit lower and lower. But the most important thing is, what is about your margin? And below 2 trades here are closed at nearly max profit, but you lost protection. And in a drawdown, your margin might explode in a spanner or in a portfolio margin account. Because when you are here, for example, you have a move here to the downside of about, let's say, 5%. Then you are here pretty at the same level. There's not much difference, and your margin will also not be very, very different. If you have here a margin to the downside, a move to the downside, then the margin will be calculated something about 12% plus minus, whereas the deepest point, including a change in volatility. And then you are here in the area of maybe, what is it, a 20K. And here you are not in this area. The lowest point here of this line here is here. And the lowest point of this year, when you take 12% and you have a move to the downside 5%, then you are in 70%, and you are here at this level, nearly 20K. And that's really not funny. And Schwalbe doesn't work as a single trade. It works as a swarm, as a phalanx, as a 6-pack. And here are examples of the margin. Here, some days ago, on the May the 12th, the SPX dropped by 5%. Of course, here my account went down by 12%, from 50 down to less than 44. But look what my margin is doing. Here it is at 26, and here is at 28. It should be 26, but I added one tranche. So the margin is 1K higher, but it's really here a move to the downside of 12%, and the margin stays at the same level. And if you have a move to the downside, you don't have a problem with your profit or with your loss. You might really have problems with the margin. And in 2018, I traded a broken wing butterfly, and that was really not fun. The biggest problem was not the net liquidation value. The biggest problem was the margin. But of course, this is not relevant in a Reg-T margin account. So my trade quality, my Schwalbe trades, my Schwalbe swarm quasi, is a wellness trade. Most of the time you sit and wait. And I'm only trading end of day and mostly good to cancel orders. And often no more additional adjustments after setup have to be done. And I have 3 security levels in a drawdown. And with 6 trades, I spread my risk instead of all in. And knockout, of course, means stop trading, but can also be a winner sometimes. And of course, I'm running my systems live since September 2019, and the new version, which I can also show here in my trade results, since November 2020. And I made an analysis 2004 to 2021. I show it now later on in an Excel sheet. I made 366 trades, and 284 were winners because I stay out of the trouble, and 160 trades without any additional adjustments. That's 45% of all trades. 69 trades crossed the knockout level, but this means trade closed, but sometimes as a winner. And 3 trades ended up somewhere between upper put and the vertical and knockout level. And Schwalbe means really very relaxed trading, very less additional adjustments per trade. And if you are employed, no problem. Good till cancel orders and end of day trading. Stay out of trouble and enjoy your life or do something else. And here are my trade results from all trades. My first trades here with the old version, you see it here, the planned capital was 4K. And the new one only have 2K planned capital. And this, of course, is for span margin, not for reg T margin. There will be a new version for reg T margin, by the way. And here you see all the trades here from September 2019 until the last one. And there's also a new one here now, which I will show you in some minutes. And you see it here, the planned capital, and the lowest point of the expiration line, which is always above here, the planned capital. And here's the deepest point of the close during the whole trade. And these are the results. And the result here in relationship to this means $550 to 2K is 27.5%. And for a 24K account here, this will mean I can trade 2 tranches, and this will be a profit of $1,100. And all these numbers are real numbers from my trading account, including commissions, including adjustments, etc., etc. There was a question. The margin requirement is in total 12,000 span. I trade 6 trades at the same time. And in E-mini, for this 12K, for this 24K account, I can trade 2 tranches. Why do I take a 24K account? Because when I switch to SPX, then I have double the size. And in E-mini, I can trade 2 tranches. And when I trade SPX, I can only trade 1 tranche, because it's the multiplier in E-mini is 50 and the multiplier in SPX is 100. So an updated version, as I said, for the reg T accounts will soon be available. And I started here, you see it, I started with quarterly trades. So I started in September until December, then from December to March, and from March to June, and from June to September. And here you see why I changed my system. Here in September, I made a nice profit, and I gave back all the profit. And that's not really funny. And the second thing is here was the next trade. And here in the next trade, there was no risk in the trade, and I could not do any adjustment for the trade because the trade was running to the upside and has never been seen again. That's why here I made the profit, 13%. Here I made the loss, 14%, that's nearly the same. And with the next trade, when I couldn't do any adjustment, then I only have 8% profit. And then I switched from here to monthly trades. You see it here, September, October, November. And from November on, as I said before, I trade 2 trades a month. And what makes my Schwalbe performing so well, I'm often asked. I think it's pretty simple. I stay out of the battle zone and I do passive trading. I don't trade actively, I do passive trading, and I want to keep my premium. And the chances are bigger when I'm out of the battle zone, when I move my entry of my vertical a little bit lower, and I give the trench time to develop, to do some to hold my premium, to keep my premium. And my members can confirm my results. I think that's very important, because the setup is pretty simple. And I enter my trade with limit orders and move it down step by step until I get filled. And that's it. And the main reason here for the bigger for the better results is here I moved the planned capital from 4K to 2K. Why? Because I don't add any additional adjustment. Because in the old trade, I added I made an adjustment when the risk was already pretty high, which means I'm near the knockout level. And this is not always possible. For example, in this trade, when it moved only to the upside, and I can't do any adjustment here. And here I don't do any adjustment anymore. The only thing is I reduce the risk here for this trade step by step. A question. If the open is 88 ATA, what is your average day in trade? The full, yes, I trade every trade until expiration. And here's your broker's statement of IB. From November on, I traded the 2 trades a month on my own account. And before it was on account of a friend where we managed all the trades together. And this account started trading the version 2 trades a month with risk reduced, and it started in November. And you see it here, this was November the 16th, there was the first trade, and I have a nice profit here and not really a much drawdown. Schwalbe, what I like most, the most thing I like in Schwalbe, and the reason why I made the changes is I can now harvesting 2 times a month. Before I have to wait 3 months for harvesting, and it was something like all in or all out. In February 2020, it was all out, but in September, it was all in. And I have pretty the same results every 2 to 3 weeks. And very important, I'm not sitting in front of my desktop most of the time. And I have nothing or very less to do during the whole trade, and I mostly use good till cancel orders because my trading is level based, and the levels are defined by the entry price. And very important for my trade, high volatility doesn't make me sweat. And I have no fancy, sophisticated, complex indicators, no black box at all, no technical analysis, nothing. And no decision needed when or where to exit, take profit or trail stop or something like that. I have the same entry signal, and the same, and the entry signals is simply always on Monday after the 3rd Friday, and on Monday 14 days after the 3rd Friday. That's it. No other entry signal, except when there is the red sign when it shows me don't trade. And the exit signals of my trade is also the same. I let it expire. I let it expire. I have no commissions at IB, except when I have a knockout level, of course. And this is my trade system, what it looks like. Here you have again, here, this was Lehman, and this was Corona, where I stopped trading and better stop trading instead of being in the trouble. Because here, why do I stop trading here? In times like this, the volatility is much too high. And if you enter a trade at the wrong time, you may get stopped out the next day. Because there are so huge moves, it really doesn't make fun. My Schwalbe system is a well-performing system, and I make about 8 to 10% per month on the whole portfolio. And you can see it, of course, in the Arrow performance. And of course, I trade the system on my own account. In the meeting every Monday, I show my own account, and all my members can see what I do, what are the good to cancel orders, and so on, and what are the fills, and so on. And this is no demo. My performance is including real fills, real adjustments, commissions, etc. So this is a short wrap-up about my system. Now I can show why can't now I can show something. Let me see here. So one moment. Where is it? This is my trading system, and here you see the red signs here when not to trade. This, of course, was the dot-com bubble. This was the Lehman. This was Corona. And for example, here was the oil, OPEC oil shock, and so on. And there are sometimes there are certain times when it's better to not trade, and it's better to make a rest instead of losing money. And in my trading, I'm not interested to catch the trend to the upside, because I'm interested. My interest is to get a premium, and the end of the trade should be above my upper put of the vertical. Now I want to show something. Why can't I quit here the thing? Scheiße. Sorry. Okay. Here is an Excel sheet. Here are all the trades from 2004 to 2021. These are all in all 366 trades. And I put this data out of my software, my investor software, which is a German software. Here you see when I started the trade on the 7th of December. It's a European format. And the end was on the 7th of March. So it's 3-month duration. And 61 means trading days, not calendar days. So this is always 3 months trade duration. And of course, I go long. And here's my enter. And here's my exit. And here's my trade high, which is not important, but the trade low is important. And here's the result. What is the result at the end? And much more important is what is the max drawdown of the trade. The relationship between the trade low and the enter basis, because I enter the trade slightly below the current price. I sell a vertical above the current price. And here you see the result was negative. And the maximum drawdown was also pretty heavy. But when I move my vertical lower, then I can move. Then I can change this negative trade into a positive trade, because I can keep my premium, because for example, I start my trade about 2.5 or 3% below the current price. But there are also trades which have a very huge drawdown. For example, here when you have a 7% or more, then it doesn't make sense to stay in the trade, because you have maybe a bigger margin or something like this. That's why I made a decision. I enter my trade lower than the current price, but there are some levels when I say, okay, it's finished. And here are 284 trades. When the exit is above the entry level, this means 77% of the trades will have no problem. Maybe a little adjustment, but no problem by ending the trade. And 69 trades end below the knockout level because I stop trading and I don't do any re-entry. I stop trading, but stop the trading doesn't necessarily mean I have a loss, because I do permanent risk reduction. And 13 trades are, these are not funny trades because they end somewhere between the exit and the entry level. But every trade has a risk reduction. And you see it here. This year, there were no trades because this was the red area where I say I don't trade. These are times in high volatility, and it's better to stay out of the market. And the same here. This was a short Corona rest when I do not trade. But of course, there are times when it's going a little bit to the downside, because I don't have 100% winners. But the percentage of negative trades here is mostly here in this area. And here you see knockout level, knockout level, knockout level. Here also knockout level. This is 2007 and 2008. Then here again some. But for example, when you have here five knockout levels in a row, that means this trade is near expiration. And near expiration means I do risk reduction during the whole trade all the time. And this not necessarily means that this will be a loser. It can also be a very profitable trade. I will show you here in some minutes. Then here again, because when you have the knockout level, you often have 6 trades in a row, which will be knocked out when you have a bigger move to the downside. And you see it here. This was 2011. And the lowest point, the drawdown was minus 15%, 16%, 12%, 14%. And they ended, most of them ended also below the 2.5 or 3% below my entry price. And of course, here 2020, here 2015 was again something like that. And here's 2018. And this trade here ended at the lowest point, for example. And here was Corona. This was February. I started the trade on the 23rd of December. And normally the trade ended on the 20th of March, but it was a knockout level. And I stopped with this trade. I didn't enter any new trade. So this is a trade which looks, this is the real trade, and this trade expired here on the end of May. And you see here my reduction levels, and I also add a vertical which moves the T+0 line to the downside if I have a huge move to the downside. And a huge move means I need more than 15 to 20% for the back ratio to put on the power. And now I can do an example. Wait a minute. Here in SPX. At the beginning, I sell a vertical. Here you have the T+0 line. And I don't open the trade at the money. I open a trade out of the money. And step by step, I add risk reduction by buying here a simple vertical, really a very simple vertical of 10 point or 20 point. It depends on risk of your what you want to have a risk. And the most important thing is, if you have a huge move to the downside, then my knockout level is about here in this area. And of course, this year, this first reduction, risk reduction will happen about 2 months after I opened the trade, because the time value is going lower and lower and lower, and the prices for the vertical is getting lower and lower and lower. And when I do it at the beginning, for example, here in this case, I have to pay 70 cents, and that's much too much, because when I do 2 or 3 of them, I really reduce here my maximum profit too much. And the point is, when I now have a move to the downside, then the volatility is going to the upside. And for the most vulnerable trades are not the newest trades, but the trades with a time of till expiration of about 1 month or so. Because when it's a pretty new trade, you have a lot of time value in the trade. And when you have a higher volatility on the move to the downside, then the volatility helps you to reduce the loss, like you see it here. I added here 20 points to the volatility, but it's a simulation. It's not real, the reality. But you see, the volatility will not make you sweat. That is what I want to show you. And it also helps the trades, and the younger the trades, the better. So for example, here you are at the level of 1350. And when the volatility is going to the upside, then you are at the level of about 700. And so you have a relationship between here and here of about 1 to 1. And this happened to my live trade in February 2020. I had a winner of this amount here, and then I have a loser of the same amount here, but in the wrong direction. And here you can also add some other risk reduction here, and then this moves the line to the upside. I have to put back here the volatility. And you can do it step by step, maybe another one or not. And when I add a back ratio, it looks like this. And when you now have a big move to the downside, not a 5% move or not a 10% move, a really big one, then it can look like this here. Look where the T+0 line is. And this is protection for the so-called black swan events. And that's why I don't want to pay a lot for this back ratio. I want to pay less than $1 for it. And you can only buy it about 2 or 2.5 weeks before expiration. But you have 6 trades, and 1 back ratio can help you to protect all the other trades, all the other 5 trades, to move the result to nearly 0 or even above. So, and what I do at the end is I reduce here the vertical which I sold at the beginning, step by step. And then I have a flat line, as you also see here in my real trade. Where is it here? It's a flat line here now. And what I'm doing additional the back ratio can hurt me when it's only 1 week or less than 1 week until expiration. That's why I also reduce here one put here, and I move one put. I have here, I sell, for example, 2 puts, and I buy 3 puts. So I have 1 netto put to the upside. And later on, I will move the strike of the lower put of the netto put here more than 100 points to the upside, and then it looks like this here. And this is what you see it here. I moved here this to the upside. I have here my stairways to heaven. I removed my, I bought back my sold vertical here at the beginning, and I reduced massively the risk of my back ratio. And this trade expired on, will expire on Friday, in 2 days. And it can't make any loss anymore. And this is now an updated version. Here you see also the trade here from May. This one expired on the 21st of May, and this one will expire on 28th. Why did I already put in the result? Because the trade can't make any loss anymore. And I don't expect a move of 15% to the downside, because here's my knockout level, about here. And when I cross the knockout level and I have a trade fully protected, then it will not make 500 profit. It will be triple the size. And this triple size here without the back ratio here. And this triple size can reduce the loss of all the trades. And wait a minute. Here you see now, a test scenario of the February when there was the huge move to the downside. In the first version, I reduced the sold vertical step by step by 10 points. And on the 27th, I have to exit all the trades. I started the trade on the 2nd of December, the 23rd, and so on. 6 trades running at the same time. And all trades were exit the 27th of February, because there was a knockout level and there was a huge move to the downside. And the result was this trade made a loss, this trade made a loss, and this 2 trade here. You see, this 2 trades here are the most vulnerable trades, because they don't have much time value in the trade, and the T+0 line is dropping to the downside. And doing adjustments here is very complicated and very expensive. So, and here is the version when I make my stairway to heaven. And here you see this trade here, which started on the 2nd of December, had already three steps to the upside. And here it's the triple result, the normally. Here you see the normal result, 440, and here you have more than triple the size. And with this result here, you can refinance the loss in the other trades, because with this trade you don't have any chance. The volatility reduces the loss a little bit from 1,000 to about 600, but you can see it here, it's always the same result. And when you use a back ratio, it really completely changed the picture. Here you see the same, because here the trade expired 1 day later on the 28th of February. But here, the back ratio shows its power, and it moved the result from minus 2,600 to plus 2,500. And the possible profit of the back ratio is somewhere, one was here at 1,800 because it ended one day later. And the maximum point of the back ratios here from the 23rd of December was, the maximum was 11,000 and the expiration was at 11,000. So it ended at the maximum profit. But this trade here, and that's really the problem with the back ratios, they you really ride a wild horse. And it can move from plus 7,000 to minus 2,000 in one day. So this was the maximum price, and in the end, the trade ended here at the negative. But if you still do it here until the expiration, in this example, then you will have a nice profit but I'm satisfied when I get out of the trade with a small profit. And here, the last picture for today, here are screenshots of my margin on the way down on the 12th of May. You see, this was the beginning, 50,000, and my margin was 26,000. And then I went down, 46, 46, 45. And here the margin was higher. Why? Because I added here one additional tranche. You see it here, there are now 3 positions. And before there were 2 positions. And it is at 28. And it moves lower, still at 28. 44 and a half, still 28. 44.3, still 28. 44. 43, this was pretty the lowest point, and still at 28. So this makes the trade really very comfortable because you don't have any problem with the margin. And I think that's the most important point in the Schwalbe trade. You have a phalanx of 6 trades which protect each other. And as soon as this trade expires, then the next trade you can add protection to the trade and risk reduction all the time, and this is what makes the trade really nice. And here you see pretty the same results all the time, because I don't want I want to take the trade. I only want the SPX to stay above my sold level, and that's it. So thank you for your attention. And now some questions, I think. The first question was...
I'm not sure how far down you got there on the questions.
Yeah, 88 days, it's okay. Every trade, I trade every trade until expiration. I don't want to pay any commissions for it. And the older the trade, the higher the protection. That's why I always trade the trade until the end. It seems your old trades protect your new trades. When somewhere it starts this first trade and it goes against it, what would be a solution since there's no old trade as a protection? The solution for that is at the back ratio from the older trades, which will be installed about 2 weeks before expiration of the old trades. And so you spend money of the premium of the first trade you do, but then you have the protection for the back ratios, but this back ratios will expire in about 2 weeks. You put on the protection only near expiration, yes, because it's cheap. And you don't have to you don't have to have protection in every trade, but you should protect your trades step by step. And as soon as one trade will expire, then the next one, the time is on your side, and you can buy the protection for a cheaper price the longer you wait. And that's why when the trade will expire, when one trade will expire, you have a good chance to buy the protection for the other trades. So the trade is not protecting in the beginning, that's right. But at the beginning, you have a lot of time value in the trade, and the volatility moves then your T+0 line a little bit to the upside. It helps the trade. It will not reduce the loss very much, but it reduces the loss. And most important is the volatility doesn't hurt you. If you stop trading, does that mean that you close all running trades? Not all trades will be closed.
I guess that depends on the knockout level for each trade.
Yes, I have individual knockout levels. You see it here. If you look here, I have 6 lines at the same time. 1, 2, 3, 4, and 5 and 6 nearly at the same level here, because the entry was the same. And when I have a move to the downside, there's a nice example, wait a minute. Here, this one. There was a huge move to the upside. And I enter the trade here. If you take 3 months from here, January 1 to 3 months, then I enter here trade, 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 and I enter here trade. And this trade will be knockout. But all the others have their individual knockout level, and you are pretty far away from the knockout level. So of course I will add some risk reduction. I will do an adjustment, but this trade will not be closed. Why? Because this trade here will expire 1 day later, and this 2 weeks later, and so on, and they will not be hurt. So I spread the risk. I have 6 individual levels and 6 individual expirations and 6 individual knockout levels. But of course, when I have here my Schwalbe signals, as you can see it here, 3 Schwalbe signals, or here even 5 Schwalbe signals, it means be prepared for it. Might, if you have this move with the same size the next day, are you below the knockout level, yes or no? And that's why I have to be prepared for both scenarios. A move to the downside for the knockout, or a move to the upside again. And that's why I don't do an adjustment in any case, because sometimes it's really much too expensive it's a matter of the relationship between what you pay and what you get. And for example, if you have here the move to the downside, you have a high volatility and the prices are very high. And if I have my knockout level, here, for example, and from here to here, I can reduce the risk here in this trade. For example, let's do this, take back. When I want to do an adjustment, here's my knockout level. And when I cross this knockout level, the game is over for this trade. And when I have to pay, let's say $500 for a risk reduction of about $100, does that make sense? Because it might be that the trade will return to the upside again. And when I have here to pay $500 for a risk reduction of only $100, that's not a good relationship. And that's why I always look at every trade of the 6 trades, which reduction makes sense and for a reasonable price and which not. And for the very young trades, the protection by the higher volatility, which moves the T+0 line to the upside, is mostly enough protection for this trade. But that's not the case for a trade with only 4 weeks until expiration, because the T+0 line is not then here, it's more than like here. And then you have a much better result if you invest, for example, $300 or $400 to move the line to the upside for a minimum $300 or $400, and that only simply means you add some more protection here, you buy some more here, and then it moves here this line to the upside. And this is no calendar. This is no calendar. This is no straddle. This is no strangle. It's simply a vertical with this different size, sometimes 10 points, sometimes 20 points. It depends really on the situation. So in the red zone, is that triggered by the breach of a lower band or VIX levels? The red zone is pretty simple. That's my secret of programming. This red line is only the yearly high minus 20%. If you cross this level to the downside, don't trade. You see it here. As soon as you have here a new higher highs, and this is end of day data, not high and low and open. And you see always when you have here a new high, then also this line is going to the upside. And if you have here is no more movement to the upside, only here it will move the line here to the upside. And it's simply the highest high of the last year, minus 20% about. And it's not optimized. And you see it here also, the long distance until a new high, which is here, then the line moves here a little bit to the upside. And there was a time of half a year with no new high. And short before a knockout here. So can you get the same results with smaller trades instead of 6? I really don't recommend that. Because the point is you get good prices for the risk reduction to the end of the trade. And you know what how a trade will, you know, how can I get that away here? Scheiße.
What are you trying to get away?
My thing,
Oh, from Windows?
Wait a minute. Close. Schließen. Ah, jetzt it. Bye-bye. I got to fill good till cancel order. That's so comfortable. That's really so comfortable. You have good till cancel order. You do anything else and you get filled for a risk reduction. That's so nice. It's really so nice. Because the levels are defined by the entry price. And then when I know which is my level where I want to buy any protection again for a low price, then I wait until I get filled and that's it. And what I want to show is why do I, wait a minute, why do I trade 6 trades? What was it? I step through it. There will be sometimes. Sorry for that. Who is it? Where is it? Oh, wrong direction, sorry. here you see this is the movement of the price of an option at the money. And here you see this is the move of an option, the price of an option out of the money. And you get here the last 30 days, you get much, you can buy options much cheaper. You can options buy much cheaper. And that's the reason why I can protect my trades the last, beginning the last 4 weeks before expiration. Then I can massively start here my protection in the trade. Here, this, of course, here the first one was here at this level. This, of course, gets filled first, and it will start about 4 weeks before expiration. And then sometimes every week you get an additional protection here, step by step. And this is my stairway to heaven. And then here also the back ratios get filled, but it's most of the time only 2 or 2.5 weeks before expiration. But then you are fully protected. And this back ratio is so powerful that it can protect all the other trades. And if you have, for example, only 3 trades, then you might be in a situation that this trade will expire and the other trades don't have so much protection. And then you have a move to the downside and have fun. That's the reason why. Have you considered doing the same strategy in USA mini options? No.
Were you using
A-mini? Sorry, I traded A-mini and I switched to SPX now. But you can trade SPY, but SPY doesn't make sense because
commissions.
The commissions, right? Thank you. And you can trade A-mini or you can trade SPX. And here you see in the trade results, these were all A-mini trades. And in June, the first SPX trade started. For example, this is my live account here. See, this were A-mini. This is also an A-mini, and this were SPX, SPX, SPX. Also SPX. But this one and this one is SPX. And here you see the different levels, which all get filled. And here is nothing to do. Everything is okay. And everything got filled and everything is fine. And it's just sit and wait until you get filled. You have to manage which levels are the best, of course. And then you have to manage what price do you want to invest. And of course, you have to invest for your protection. And most of the time, the protection is in vain. But I think it's always worth to add the protection, because when you have a move to the downside, it's too late. Then you don't pay, for example, 30 or the 40 or the 50 cents for protection. Then you pay $3 or $4 or $5. You don't get the protection for this price because the volatility is immediately going to the upside, and yeah. Then your option will not cost, let's say $3. Then your option costs $12 or $13, and the difference between the spread between the options here for a vertical is also going to the upside. So that really doesn't make sense. Why did I switch from ES to SPX? Because some members trade SPX and I just want to test it. That's all. And there's one more difference. In SPX, for the prices of the options, you have steps of 25 cents. And in SPX, you have steps of 5 cents. And for example, if you get in the SPX, you have the steps of 25 cents and 50 cents. And you don't get, for example, $12.50, you only get $12.25. You may get in the SPY compared to this, a price of $12.45 or $12.40. And here you only have the choice between 25 and 50. And when you don't get 50, you only can get 25. But in SPX, you can get 40 or 45 or 25 or 30. So, and this is all I do live in the meeting, and you see it also here in the wrong one, sorry. No, this is all in the Schwalbe Trade, and you see it here. Here is the link. And if you have any more questions, here's my private email, or you can mail to iggy@aromir.com, where you can ask some more questions. And I can really recommend my trade. I have a performance here of, I mean, the performance is really not that bad. I have a performance of about 7 to 8% per month. And you see here the results, they're pretty the same all the time. In high volatility, you get more risk premium, and in low volatility, you get less risk premium. But it's really very smooth trading. It's very boring trading, very lazy trading all the time. And 6 trades at the same time. And yeah, you have a phalanx of 6 trades in a 6-pack, and the trade protect each other. And it's really easy going, and you sit and wait, because the business model, the business case of an insurance company, you see a lot of insurance, and you know why? Because they make really a good business. And it's a good business case here to sell insurances, but of course, buying reinsurances. And that's it in a nutshell. So I think that's it.
Well, there was one question. Do you explain the rules and guidelines completely so that they could trade it on their own?
Yeah, sure. In the meeting, I do it, of course. But of course, you need some experience when you get in trouble.
Right.
Normal trading is pretty easy. You can get it in 5 minutes. But when you get in trouble, you need some experience, and hopefully you don't get in trouble, but it will happen, and you can see it here. There are always some times when you might get in trouble. Here you see, when you see here this line here, the brown signals, when it's to the downside, then I do the first adjustment. And when you have here the pink, then I have the second adjustment, because these are bigger drawdowns. But I survived all of these drawdowns here. I survived all of these drawdowns. Here I went out of the trade. In September, to do the picture completely, I started here on the 23rd of September. And 1, 2, 3 months until 16th of December, I made a nice profit, because my trade here, I only traded one trade, and that's was this one. And then here I started a new trade, and here I got a knockout. Here I started a new trade. Here I started a new trade, and here was some trouble. And here I started a new trade. Here was some trouble, and also adjustments. And being prepared here for both scenarios is a little bit not that easy. And here again, here I started the next trade, and here also 1 week I started the next trade.
There were a couple of questions about the software you're using. Is it possible to figure out all the break levels without using the software?
Yeah, sure.
And
it's only levels. It's the levels are pretty easy, because the levels are defined by the entry price. And when you enter here the price here, then you know your levels, and you also know your risk reduction levels. That's only it's a simple Excel, nothing more. So Investors Program is a German software and no English software. So do you need to have investors? No. Don't
That's
buy
why
it.
you have it.
Yeah, for the levels, it's just a simple Excel sheet. I tell you all the levels when you join the service. Then you have all the levels, and you put in good till cancel orders most of the time, and that's it. And when you enter here the trade, for example, when you enter here the trade, then you have your adjustment levels, your your risk reduction levels, which will be filled here to the end of the trade. So it will be somewhere in this area, and this, of course, is here some. It's a complicated trade, and you see it also here in my results, because here I had to do some adjustments here, and that's why I don't get so much premium. I get much less premium because I have to do adjustments, and adjustments always need reduces your maximum premium. Meetings are on Mondays, yes, because I enter my trades Mondays. And of course, you get messages, SMS, and emails, what strikes I use, what expiration, but expiration is 3 months, DTE is 88 normally. And the meeting is always on Monday because I enter my trade on Monday. And the meeting.
You open it near the close of the market?
Yes, it's 2 hours before. 2 hours before the market closes, there's the meeting, and I also tell all my members what I intend to do. And of course, about half an hour, I say concrete what strikes I use, and that's it. And at the beginning, it's a simple vertical. That's not really rocket science. It's really a simple vertical to sell to get the premium, but the level is important. Not at the money, out of the money a little bit. Because if you want trouble at the money, have fun. That's really not fun. I promise you.
Yeah, been there, done that. Yeah.
Yeah. And it's really boring trading. And that was also a reason why I changed from 3 months to two trades a month, because sometimes you don't have to do anything in a trade, and that's for 3 months, and that's really boring. And of course, you have the risk of all in. And with 6 trades here, look here, every 14 days you can harvest. Isn't that nice? And with a profit of about 7% per month, between 7.5% and 10% per month. And that's
Now,
really
for somebody
nice.
starting out new, do you recommend using SPX or ES?
Yes. Lower your risk, because for a 6-pack in E-mini, you need 12K. And for SPX, you need 24K.
Now, one possibility might be if you use the broker Tradier, they have flat commissions. So like on SPY, it might be doable. You know, you pay like $60 a month and then you're just paying exchange fees. But SPY is a lot different than SPX as far as that goes, because it's traded on multiple exchanges. So that
Yeah,
might be another possibility for somebody.
yeah. Because here I have the SPY and the SPX, and it's pretty the same. It's
Yeah,
all pretty the same.
should be.
Yeah, sure. Would be a wonder if not.
Yeah, there'd be an arbitrage possibility if not. Yeah.
Immediately. And yeah, here you see where are we now? 93 to 90 to was sind das hier? Moon prices hier. Bid ask, yeah, sure. Okay.
Because the market's closed, they just widen out the bid-ask spread.
Yeah.
Yeah.
One advantage in E-mini is, of course, you get filled all the time between Sunday afternoon until Friday.
Yep.
And
And if the
then
market's moving overnight, you can actually trade it too. You know, like the elections, for instance. I remember when 2016, the E-minis went crazy overnight. And by the time the regular US market opened, it was like, oh, it's back to where it started.
Yeah. Okay. Yeah. And I do my trades in SPX, executing also not only real-time hours, but also the European session.
So good question from Ram. If Monday's a holiday, do you trade on Tuesday? I guess you have to, unless you're doing ES.
Yeah, sure. I don't want to open the exchange for only for me.
Well, they could, but
For a little money.
yeah. All right. Well, I think. Oh, wait, another question. So on SPX, do you need to do 2 tranches for the adjustments, or is that just for the account size?
2 tranches, yeah. I don't understand that question.
I know there was one question. If you're new, how many tranches would you start with? You wouldn't put 6 on, because obviously you're going to have to keep rolling them off. But would you just do 1 every 2 weeks if you're new?
If you invest 12K, you can only do one tranche. So one tranche is planned capital for each tranche in E-mini is 2,000, and you need 6 of them. So if you trade six trades, which you really should, your 6-pack means 12K. And if you have if you plan to invest 12K, then you can only trade 1 tranche. And and for example, on my account, I trade between 4 and 5 tranches in E-mini. It's a 50K account.
And there was a question about taxes.
No.
I think they do, because the futures are they're that 60/40 tax treatment, and so are the index options on SPX. If you traded SPY, you would not have that though.
I'm Stuttgart. I'm not USA.
Yeah. And I think I did an article on that if I can find it.
A guy told me there will be a change in SPX trading around the hour, around the clock in the 4th quarter. Is it true?
Oh, I haven't heard that. There's the article I wrote a couple of years ago about tax advantage options, so that gives you a better idea of what's tax advantaged.
Yeah. No, one guy told me last week there will be a change in SPX trading around around the clock in the 4th quarter this year.
Oh, Bruce heard that also.
Hmm?
Bruce also heard that.
Oh yeah, okay.
So wow, that's a good change. And we have a session scheduled for next Monday, but the market's closed. Do you want to move that to Tuesday?
No.
Or still do it on Monday? Well, it's not a holiday for you, right? You're in Germany.
Yes, but Pfingstmontag was a holiday here in Germany, but nevertheless I made the meeting here. And you get a SMS. You get a SMS which strikes I intended to do, and so this will be about half an hour before the market will close, and then you don't get the message on Monday, and then you get the message on Tuesday. It doesn't make any difference, but the meeting will be on Monday.
Oh, and Masood asked, do you recommend 1 tranche? And tranche is actually the French word for slice. It's that's where it comes from. So do you recommend 1 tranche to start an SPX for new customers?
Yeah, but then you need a planned capital of all the tranches of 24.
Right. So whatever your capital is, divide by 6 and use that much.
Yeah.
Yeah.
And very important, you need span margin. If you have reg T margin, it's not possible because the back ratio will blow you away.
So if you want to do
SPX,
SPX,
very important. This is calculated with span margin or portfolio margin, not a reg T margin, because when I add a back ratio, the maximum, the T+0 line, the expiration line, the lowest point of the expiration line will be not at 2K, it will be at 10K. So be aware of that. But I will do a version for RecT accounts, because I have to replace the back ratio by something else, and I'm just testing it. But I think there will be a solution.
There's a question about why is this trade called a Schwalbe, and I just put that in there. One swallow doesn't make a summer, and then Schwalbe is the German word for the swallow bird.
Yes, and that means here, for example, in this case, here you have one Schwalbe. And one Schwalbe is not really, if you only have one Schwalbe, there will not happen much. As you can see it here, one Schwalbe, one Schwalbe, one Schwalbe, one Schwalbe, one Schwalbe. But here you have three of them. And then, oh, that's not one, that's three. That's not one, that's six. Oh. Be prepared. There might be
look out
something
below
around the corner.
Yeah. All right, I think we've gone through all the questions, Iggy.
Yeah, okay.
And we're a little over, but that's okay. It's always good to keep it going with the people who are interested. So again, if you are interested in joining, I'll just put the URL in the chat here. Okay. And I've heard some people having difficulty pronouncing it, but it's the German, the E at the end is a kind of a sound. So it's not Schwalbe or Schwalbe, it's just Schwalbe.
Schwalbe, like Schwabe.
Yeah. All right.
Yeah.
So I think that's it. Any
aware,
last thing?
It's passive trading. It's not active trading. It's really passive trading. You sit and wait. It's not adrenaline trading. It's really boring, lazy.
Slow and steady wins the race, right? Like the rabbit and the hare.
Maybe.
And next meeting, I guess, would be Monday the 31st.
Yes.
Yep. Perfect.
Okay.
All right. Thanks everyone for sticking with the end. Iggy, great trade. I love it. It's easy to monitor, and like you said, most of the time, like almost half the time, you don't have to make any adjustments. The GTC orders just kick in, and you might be on the golf course and ding, I just got to fill, right? So yeah, very nice. So I appreciate.
I practice. I don't play golf. I practice.
Oh, you practice. Okay. Yep. All right.
Okay.
So vielen Dank
you,
for alles. Yep. And we'll see you next time.
Okay. Bye-bye.
Bye.